Have you ever found yourself staring at a dollar bill and wondering about the intricate details and symbolism behind it? Or have you ever wondered how some people seem to effortlessly accumulate wealth while others struggle to make ends meet? Whether you're a curious spender, a savvy investor, or just looking to improve your financial literacy, understanding key money concepts is essential in today's world. From budgeting and saving to investing and retirement planning, having a strong grasp of financial concepts can help you navigate the often murky waters of personal finance. So buckle up and get ready to learn about the money concepts you must know to take control of your financial future. Net worth. Picture this: you've just won the lottery and you're feeling like $1 million, or maybe even more. But have you ever stopped to think about how much you're actually worth financially? No, we're not talking about your worth as a human being, because let's be real, you're priceless, but your net worth in dollars and cents. Net worth is a fancy financial term that simply means how much money you have left over after you subtract all of your debts and liabilities. It's like taking inventory of your finances and seeing how much you're really worth. Think of it as your financial report card, but instead of grades, you get a dollar amount. So what does having a positive net worth mean? It means you're doing pretty darn well, my friend. You've got more assets, like cash, investments, and property, than liabilities, like credit card debt and loans. It's like having a savings account with a big fat balance that just keeps growing. On the other hand, having a negative net worth means you owe more than you own. It's like having a bottomless pit of debt that just keeps getting deeper and deeper. But don't worry, even if you're not a high net worth individual, aka someone who's got more money than they know what to do with, you can still work towards improving your net worth. And who knows, maybe one day you'll be able to buy that private island you've always dreamed of. Interest. Now let's talk about the wonder of interest. It's like a two-faced coin that can work for or against you depending on how you use it. When it comes to saving money, interest is like having a little helper that works for you 24/7. You put your money in a savings account, and the bank uses that money to invest and make profits. But don't worry, you're not just giving your money away for free. The bank pays you interest for letting them use your money. It's like renting out your money for a fee, and the longer you keep your money in the account, the more interest you'll earn. It's a win-win situation. But let's flip that coin over. When you borrow money, interest can be a real pain in the you-know-what. It's like having a pesky little leech that sucks money out of your wallet every month. You borrow money from someone, like a credit card company or a lender, and they charge you interest for the privilege. And if you take a long time to pay back the loan, the interest just keeps piling up like a never-ending stack of pancakes. Trust us, you don't want to be drowning in interest payments. So yes, interest can be your best friend or your worst enemy. Use it wisely, and you'll be on your way to financial success. Bear market. Have you ever heard of a bear market? No, it's not a place where actual bears trade stocks and bonds, and not somewhere you go to buy bears, although that would be pretty hilarious. A bear market is actually a term used to describe a time when the stock market is in a bit of a slump. It's like a big grumpy bear that just wants to hibernate and doesn't care about making anyone rich. Share prices start to fall, people lose their jobs, and the economy takes a nosedive. It's not exactly a party if you know what we mean. But here's the good news. A bear market can actually be a great opportunity for savvy investors. Why? Because when the prices are low, you can buy up stocks at a discount and wait for the market to rebound. It's like going to a Black Friday sale and snagging a fancy TV for half the price. Except instead of a TV, you're buying stocks. And instead of waiting in line at 3 a.m., you're sitting in front of your computer with a cup of coffee. Of course, not everyone sees a bear market as a chance to make money. Some folks get scared and start selling off their stocks like they're going out of style. It's like a game of musical chairs, and everyone wants to be the first one to sit down. But as the saying goes, the early bird gets the worm, or in this case, the profit. Liquidity. Do you ever feel like your money is stuck in a game of red light, green light? Do you want to use it or convert your assets to cash, but the process seems to be taking forever? Well, that's where liquidity comes into play. Liquidity is like having a magic wand that can turn your assets into cash in a snap. The more liquid your assets are, the easier it is to get your hands on cold, hard cash. Think of it like this. Cash is the most liquid asset of all. It's like having a bunch of dollar bills in your pocket that you can spend anytime, anywhere. But other assets, like real estate or collectibles, are less liquid. It's like having a giant dinosaur statue that you want to sell, but no one seems to want to buy it. We're not judging your decor choices, we promise. When it comes to evaluating liquidity, financial professionals use fancy-sounding ratios like the current ratio or asset test ratio, but basically it just means they're figuring out how quickly you can turn your assets into cash. Now, there are two types of liquidity to keep in mind. Accounting liquidity is like a person's ability to pay their bills on time. No one wants to be late to the party. And market liquidity is like a bustling flea market where buyers and sellers are swarming around, ready to make deals. So the next time you're feeling like your assets are stuck in a game of red light, green light, just remember, liquidity is your magic wand to turn them into cash in a snap. Compound interest. Let's talk about compound interest. It's like a magical unicorn that can turn your money into a giant pile of gold. Just like how unicorns multiply, compound interest multiplies your money over time. Don't worry, I don't get it either. It's like a snowball rolling down a hill. It starts off small, but as it rolls, it picks up more snow, or in this case, interest, and gets bigger and bigger. See, the snowball thing made a bit more sense than the unicorn thing. For example, if you invest $100 and earn 7% interest annually, after 1 year, you'll have $107. But here's where it gets exciting. The next year, you won't just earn 7% interest on your original $100, but on the $107 you already have. So now you'll earn $7.49 instead of just $7. See how that adds up over time? That's the power of compound interest. Credit. Moving on to the next topic, which is none other than credit. No, not the kind of credit you get for writing a paper, but the kind of credit that lets you buy things without having to pay up front. It's like magic, except it's real. Basically, credit is when you borrow money from a lender and promise to pay it back later, usually with a little extra. Hello, interest. You can use credit to buy all sorts of things, from a new car to a fancy dinner out with friends. But credit isn't just for individuals. In the world of accounting, credit is also a fancy term for a financial transaction that can either increase a company's liabilities or decrease its assets. It's like a little dance that companies do to keep their books balanced and their accountants happy. So whether you're buying a new pair of shoes or keeping your company's balance sheet in check, credit is a pretty important concept to know. Just make sure you don't go overboard and end up buried in debt. As they say, with great credit comes great responsibility. Inflation. Lastly, inflation is like the price-hiking monster that creeps up on us every year, making our dollars shrink in size like they're scared of it. It's like a game of how high can we go for prices of goods and services, and unfortunately, we're usually on the losing end. It's like playing a never-ending game of tag with your money, but no matter how fast you run, inflation always seems to catch up. So it's important to make sure your income is running just as fast as inflation, or else you'll be left in the dust with a wallet full of smaller dollars. So there you have it, folks. These are just a few of the money concepts that you must know to master your finances. Remember, financial literacy is a journey, not a destination, so keep learning and growing your money knowledge. And while you're at it, don't forget to hit that like and subscribe buttons to stay up to date with all the latest tips and tricks. Happy saving and investing. Thanks for watching.